Look, I need to show you something that's happening right now in the currency markets that most people aren't paying attention to. And when I say most people, I mean the vast majority of investors who are about to get caught on the wrong side of the biggest monetary shift in 50 years. There's a window closing, and it's closing fast. Let me paint you a picture of what's actually happening behind the scenes. While everyone's watching stock market headlines and debating whether we're in a recession or not, there's a quiet exodus taking place. Central banks around the world are dumping dollars at a pace we haven't seen since the 1970s. But here's what makes this different from anything we've experienced before. They're not just diversifying, they're running for the exits. The numbers tell a story that should terrify anyone holding significant wealth in dollar-denominated assets. In the past 18 months, central banks have purchased over 2,000 tons of gold. That's not a typo. 2,000 tons. To put that in perspective, that's more than the entire gold reserves of Germany, and they're the second largest holder in Europe. But here's the kicker. These aren't small emerging market central banks hedging their bets. We're talking about major players: China, Russia, India, Turkey, Poland. Even traditional Western allies are quietly building their gold reserves at levels that would have been unthinkable a decade ago. Why now? What do they know that the average investor doesn't? Let me take you back to a conversation that happened in a closed-door meeting in Basel, Switzerland. This is where the Bank for International Settlements operates, essentially the central bank for central banks. According to sources who were in that room, the discussion wasn't about if the dollar's reserve status would erode, but how quickly it would happen and what the fallback position should be. The consensus? Physical gold, not gold ETFs, not gold mining stocks, physical metal that sits in vaults under sovereign control. Think about what that means. These are the people who literally create money. They understand the system better than anyone. And they're choosing to convert their paper assets into physical metal at a rate that's accelerating every quarter. Now, you might be thinking, okay, but the dollar's been the reserve currency for decades. It's not going anywhere overnight. And you'd be partially right. This isn't an overnight collapse. But that's exactly what makes it so dangerous. It's a slow-motion train wreck that gives you just enough time to think you're safe, right up until you realize the exit door has narrowed to the point where you can't get through. Let me show you what I mean with some real numbers. The dollar's share of global reserves has dropped from 73% in 2001 to under 58% today. That might not sound dramatic until you realize that represents trillions of dollars being reallocated. Where's it going? About 15% has moved into gold, another chunk into euros, yen, and yuan. But here's the critical part. The pace of that decline is accelerating. In just the last 3 years, we've seen the same percentage drop that took a decade to happen in the early 2000s. The currency exit I'm talking about isn't some theoretical future event. It's happening right now, in real time, and the window to position yourself on the right side of this trade is getting smaller by the day. Let me tell you about what happened to a group of investors in Turkey. Back in 2018, the Turkish lira was trading around 4 to the dollar. People there had their savings in lira-denominated accounts, thinking they were safe because, well, it was their national currency. The government said everything was fine. The banks said everything was fine. Then reality hit. Within 2 years, the lira collapsed to 8 to the dollar, then 10, then 15. Today, it's over 30 to the dollar. People who had 1 million lira in savings saw their purchasing power cut by 85%. Their life savings gone. Not because they made bad investment decisions, but because they trusted that their currency would hold its value. Now, I know what you're thinking. That's Turkey. That's not the United States. We're different. And yes, we are different. We have the world's largest economy. We have the most powerful military. We have deep, liquid capital markets. But here's what people forget. We also have $34 trillion in debt. We're running trillion-dollar deficits every single year with no plan to stop. We're printing money at a pace that would make a banana republic blush. And most importantly, the rest of the world is starting to notice. The BRICS nations, Brazil, Russia, India, China, South Africa, they're not just talking about creating an alternative to the dollar anymore. They're actively building the infrastructure to trade without it. Saudi Arabia, our longtime ally who has priced oil in dollars since 1974, is now accepting yuan for oil sales to China. The UAE is doing the same. Even France has completed its first LNG trade in yuan. These aren't symbolic gestures. These are the building blocks of a new monetary system that doesn't have the dollar at its center. And here's where it gets really interesting. When you look at what's happening in the physical gold market, you see something that doesn't match up with the paper price. There's a massive disconnect. The COMEX, where gold futures are traded in New York, shows one price. But if you try to buy physical gold in size, you're paying premiums that are 5, 10, sometimes 15% above that paper price. Why? Because there's a shortage of physical metal. The vaults are being drained. Refineries are running at full capacity and still can't keep up with demand. This is exactly what happened in the 1970s, right before gold went from $35 an ounce to $850. Let me walk you through the mechanics of what's happening. The paper gold market, the futures and derivatives, is roughly 100 times larger than the physical market. That means for every ounce of actual gold that exists, there are 100 paper claims on that gold. It's a fractional reserve system, just like banking, and it works fine as long as everyone doesn't try to convert their paper into physical at the same time. But what happens when central banks, the biggest players in the game, start demanding physical delivery? The system breaks, and we're seeing the early signs of that break right now. Quick aside here, and this is important if you're sitting on significant retirement savings. If you have $100,000 or more in traditional retirement accounts, IRAs, 401ks, there's a way to get physical gold into those accounts without triggering taxes or penalties. I put together a comprehensive guide on how gold IRAs actually work, the mechanics, the custodians, the storage, all of it. It's free, and you'll find it in the description below. Worth looking at if you're concerned about protecting your retirement from currency devaluation. All right, back to what's happening in the markets. The Shanghai Gold Exchange, which is where physical gold trades in China, consistently shows prices above London and New York, sometimes significantly above. That premium tells you everything you need to know about where the real demand is. China isn't buying paper promises. They're taking delivery of physical metal and moving it into vaults where Western institutions can't touch it. They've been doing this systematically for over a decade, and they're not slowing down. Now let's talk about what this means for the average person, for someone who's worked their whole life, built up savings, and is trying to figure out how to preserve their wealth through what's coming. Because that's really what this is about. It's not about getting rich quick or timing the market perfectly. It's about understanding that the rules of the game are changing and positioning yourself accordingly. Think about your wealth like a game of musical chairs. Right now, there are more people holding dollars than there are safe havens to move into when the music stops. Gold is one of those chairs. Real estate in the right markets is another. Productive assets, businesses, commodities. But here's the thing about musical chairs. The people who wait until the music stops to start moving are the ones left standing. The smart players are already quietly moving toward the chairs while the music is still playing. I want to show you something that happened in 1971 that most people have forgotten. Nixon closed the gold window, meaning foreign governments could no longer exchange their dollars for gold at the fixed rate of $35 an ounce. At the time, most Americans didn't think it was a big deal. The stock market actually went up initially. People went about their lives. But over the next decade, something insidious happened. Inflation ravaged the purchasing power of the dollar. What cost $1 in 1971 cost $3 by 1981. People's savings were cut by 2/3 in real terms, and the only people who were protected were those who had moved into hard assets, primarily gold, which went from $35 to $850 during that same period. We're in a similar moment right now, except the stakes are even higher because the dollar isn't just losing its domestic purchasing power, it's losing its international reserve status. And when that happens, when the world doesn't need to hold dollars to conduct trade, all those dollars that are sitting in foreign central banks and sovereign wealth funds, they're going to come flooding back home. That's trillions of dollars of demand for U.S. goods and assets that will drive prices through the roof. The Federal Reserve knows this. They're trapped. If they raise interest rates to fight inflation, they collapse the economy and make the debt unsustainable. If they keep rates low and print money, they accelerate the dollar's decline and fuel more inflation. There's no good option. And that's why you're seeing smart money, the people who understand how this game works, moving into assets that can't be printed, that can't be devalued by government decree. Let me tell you about a pattern I've noticed in the data that's deeply concerning. Every time there's a crisis, a banking crisis, a sovereign debt crisis, a geopolitical flare-up, gold spikes. But then it settles back down and people think the danger has passed. What they don't realize is that each successive spike is higher than the last, and each bottom is higher than the previous bottom. We're in a stair-step pattern that's been building for 2 decades. Gold was $250 an ounce in 2001. It hit $1,900 in 2011, pulled back to $1,050 in 2015, then climbed to $2,075 in 2020, pulled back to $1,600 in 2022, and now we're pushing toward $2,700. Each cycle, the lows get higher. Each cycle, the highs get higher. And each cycle, the fundamentals driving the move get stronger. But here's what's different about this cycle. In previous cycles, gold was moving up primarily on inflation fears or financial crisis fears. This time, it's moving on something much more fundamental, a loss of confidence in the entire dollar-based monetary system. That's not something that gets fixed with a Fed rate cut or a government stimulus package. That's a structural shift that takes decades to play out, and we're only in the early innings. The commercial banks, the big players like JP Morgan, Goldman Sachs, they're net long gold for the first time in years. That means they're betting on higher prices. These aren't gold bugs or conspiracy theorists. These are the most sophisticated trading operations in the world, and they're positioning for a major move up. At the same time, you're seeing a record number of short positions being squeezed out of the market. Hedge funds that were betting on lower gold prices are being forced to cover, which creates a feedback loop that drives prices even higher. Now, let's talk about the supply side, because this is where things get really interesting. Gold production peaked in 2018. Since then, it's been flat to declining. The easy gold has been mined, the ore grades are getting lower, the costs are going up, and there are no major new discoveries coming online. Meanwhile, demand is at all-time highs. You've got central banks buying, you've got Asian consumers buying, you've got investors buying, and you've got industrial demand from electronics and technology that's not going away. When you have declining supply and increasing demand, there's only one direction for price to go. But there's another factor that most people aren't considering: the energy cost of mining gold. It takes an enormous amount of energy to extract gold from the earth, process it, refine it. As energy prices rise, which they inevitably will as we transition away from fossil fuels and deal with underinvestment in energy infrastructure, the cost of producing gold goes up. That puts a floor under the price. Gold below a certain level simply doesn't make economic sense to mine. We're approaching that level now for many operations. I want to circle back to something I mentioned earlier about the paper versus physical disconnect, because this is crucial to understanding what's coming. The COMEX has rules that allow for cash settlement of contracts instead of physical delivery. That means if you're holding a gold futures contract and you demand delivery, they can just pay you cash instead, based on the paper price. But what happens when enough people demand physical and the vaults are empty? The system breaks. And we've seen this movie before. In the 1960s, the London Gold Pool tried to suppress the price of gold by selling physical metal into the market. It worked for a while, until it didn't. They ran out of gold, the pool collapsed, and the price exploded. We're seeing the same dynamics today, just on a much larger scale. The difference is that this time, it's not just about the gold price. It's about the entire architecture of the global monetary system. When the paper gold market breaks, and it will break, it's going to expose the fact that there isn't enough physical gold to back all the claims. And that's going to trigger a repricing of gold that will make previous moves look tame. Let me give you a thought experiment. If central banks around the world decided they wanted to back their currencies with gold at even a modest percentage, say 20%, what would the price of gold need to be? There are roughly 200,000 tons of gold that have ever been mined in human history. About 35,000 tons of that is held by central banks. The rest is in jewelry, private hands, industrial applications. If you take the total amount of global currency in circulation and divide it by the amount of gold available, you get a number that's multiples of where we are today. Some estimates put it at $10,000 an ounce. Some say $20,000. The exact number doesn't matter. What matters is that gold is dramatically undervalued relative to the amount of currency that's been created. And here's the thing, you don't need every central bank to go back to a gold standard for this to happen. You just need enough of them to start demanding gold as a reserve asset that the available supply gets tight. We're already seeing that. The question isn't if gold reprices higher. The question is how fast it happens, and whether you're positioned before it does. Now, I want to address something that I hear all the time from skeptics. Gold doesn't pay interest. It doesn't generate cash flow. It just sits there. And they're right. Gold doesn't do anything. It doesn't grow. It doesn't produce. It just exists. But that's exactly the point. In a world where every financial asset is someone else's liability, where every currency is being debased, where every government is running unsustainable deficits, gold is the one asset that has no counterparty risk. It can't default. It can't be printed. It can't be hacked. It simply is. And in times of monetary chaos, that property becomes incredibly valuable. Think about what happened in 2008. Lehman Brothers collapsed. Bear Stearns collapsed. AIG needed a bailout. Money market funds broke the buck. People who thought their wealth was safe in the AA-rated securities found out those ratings were worthless. The only assets that held their value were physical assets, things that couldn't be printed away or defaulted on. Gold went from $800 an ounce in 2008 to over $1,900 by 2011. Not because gold became more valuable, but because people realized that paper promises weren't as safe as they thought. We're heading into a similar period, except this time the crisis isn't going to be contained to a few banks or a housing market. It's going to be a sovereign debt crisis, a currency crisis, and a crisis of confidence in the institutions that have managed the global economy for the past 80 years. And when that happens, the flight to safety isn't going to be into treasury bonds or money market funds. It's going to be into assets that can't be manipulated by central banks. Let me show you what's happening in the options market, because this tells you what the smart money is expecting. There's been a massive increase in call options on gold, bets that the price will be significantly higher in the next 6 to 12 months. But what's really interesting is where those strikes are. People aren't buying calls at 2,800 or 3,000. They're buying calls at 3,500, 4,000, even 5,000. These are sophisticated traders putting real money behind the belief that we're going to see a moonshot move in gold. And they're not doing it because they're gold bugs. They're doing it because they see what's coming in the currency markets. The currency exit I'm talking about isn't just about central banks and institutional investors. It's about regular people waking up to the fact that their savings are being quietly confiscated through inflation and currency debasement. Every time the government runs a deficit and the Fed prints money to finance it, they're diluting the value of every dollar you hold. It's a hidden tax that doesn't show up on your tax return but is just as real as income tax. And it's accelerating. Look at what's happened to the cost of living over the past few years. Housing prices have doubled in many markets. Food costs are up 30, 40, 50% depending on what you buy. Energy costs are volatile but trending higher. Healthcare costs continue to climb. Education costs are out of control. Meanwhile, the official inflation numbers say everything is fine, just a modest 3 or 4% increase. The disconnect between what the government says inflation is and what people experience in their daily lives has never been wider. And that disconnect is eroding trust in the system. When people lose trust in their currency, they start looking for alternatives. In some countries, that's dollars. In others, it's euros or yuan. But increasingly, people are realizing that all fiat currencies have the same problem. They can be printed without limit, and that's driving demand for the one form of money that can't be printed: gold. I want to take you back to another historical parallel that's instructive. In the late 1970s, inflation was raging. The Fed, under Paul Volcker, raised interest rates to 20% to break the back of inflation. It worked, but it caused a severe recession. Unemployment spiked. Businesses failed. It was painful. But here's the key difference between then and now. In 1980, the U.S. debt to GDP ratio was around 30%. Today, it's over 120%. We can't afford to raise rates to 20% because the interest payments on the debt would consume the entire federal budget. We're trapped in a low-rate environment, which means we can't fight inflation the way Volcker did. The only option is to let inflation run, which means the dollar continues to lose value, which means gold continues to go up. The math is simple, but brutal. If you're holding dollars and inflation is running at 5% per year, you're losing 5% of your purchasing power every year. Over a decade, that's a 40% loss. Over 2 decades, you've lost more than half your wealth. But if you're holding gold, which historically has kept pace with or exceeded inflation over long periods, you're preserving your purchasing power. It's not about getting rich. It's about not getting poor. Now here's where the currency exit becomes critical. As more people and institutions figure this out, the demand for gold increases. But the supply is fixed. There's only so much gold in the world, and most of it is already owned by someone who doesn't want to sell. That creates a squeeze. And in a squeeze, prices can move much faster than anyone expects. We saw this in 1979 and 1980 when gold went from $200 to $850 in less than 2 years. We could see something similar, or even more dramatic in the coming years. The signs are all there if you know where to look. The premiums on physical gold, the central bank buying, the declining dollar reserves, the geopolitical tensions. the unsustainable debt levels, the money printing, the inflation. Each one of these factors alone would be bullish for gold. Together, they create a perfect storm. And here's the thing that keeps me up at night. Most people aren't prepared. They're sitting in cash, thinking they're safe. They're in bonds, thinking they're conservative. They're in stocks, thinking they're diversified. But none of those assets protect you from currency debasement. None of them protect you from a loss of confidence in the monetary system. And when the exit door narrows, when everyone realizes at the same time that they need to get out of paper and into hard assets, it's going to be chaos. The window is still open, but it's narrowing. Every day that goes by, more smart money moves into position. Every day, the available supply of physical gold gets a little tighter. Every day, the fundamentals get a little more bullish. And every day, the risk of being caught on the wrong side of this trade gets higher. I'm not saying you should panic. I'm not saying you should put everything into gold tomorrow. What I am saying is that you need to understand what's happening. You need to have a plan, and you need to act before the window closes completely. Because once it does, once the currency exit becomes obvious to everyone, it will be too late to position yourself at reasonable prices. The great wealth transfer that's coming isn't going to be from one generation to another. It's going to be from people who hold paper assets to people who hold real assets. From people who trust the system to people who prepared for the system to change. From people who waited to see what happens to people who saw what was coming and acted. The choice is yours. You can wait and hope that somehow the debt gets paid down, the deficits shrink, the money printing stops, and everything goes back to normal. Or you can look at the evidence, understand that we're in the middle of a historic monetary shift, and position yourself accordingly. The currency exit is narrowing. The question is whether you'll make it through before the door closes.